Inflation is starting to evaporate a lot faster than most people believe. Consumer prices are falling like a rock. We're at 3%. We're due to be in the twos pretty soon. The Fed funds rate is at 5 to 5.25. We're in restrictive territory. This is what the Fed wants. We're up 500 basis points of hikes. Okay, another 25. Ooh, you think the market really cares? I don't think so. It really cares about earnings bottoming. For those of you out there that say, okay, inflation is so sticky, well, this is month on month core CPI. If we annualize it, we're basically at 2%. We're at the Fed's target. That was the lowest core since October of 2021. We're under 2% annualized. It's not sticky, it's evaporating. Shelter is the primary component keeping inflation sticky and keeping the Fed from ending the war against inflation. Once shelter drops, once it comes in, which it's really dropping in real time, but once that actually shows up in the numbers, I think the Fed is done. Shelter is due to collapse. If we look at Redfin data, if we look at Zillow rents, if we look at the Case-Shiller home price index, it's all falling. So inflation is falling while growth is set to rebound. Now, this is where we get bullish. This is where I was wrong. I thought growth would keep decelerating at a faster pace, but it looks like we're starting to bottom. GDP forecasts are going up. Estimates for real GDP growth in Q2 of 2023 is now at 2.3%, up from 2.1%. The GDP now forecast is basically revised up for some reason. I wonder why. Well, payrolls, consumers. 2 weeks ago, we had GDP expectations at 1.4%, and they came in at 2%. When estimates start getting beat, you can now forecast that things are better than expected and we could be troughing, we could be bottoming. And if that is the case, the market loves it because the market is forward looking. It looks 12 months ahead. Consumer sentiment is rebounding. Incomes are still steady because people still have jobs. The savings rate is rising. If you lost your job, we saw a lot of layoffs. There's another job to be filled, right? The service activity, the service PMI, it's basically looking forward and we did get that bounce. So services are bouncing. Consumer debt is up at all-time highs. Well, it doesn't matter. As long as the debt can be serviced, the economy is going to keep chugging forward. So as long as people have a job, they can service the debt. As long as their incomes are rising, they can service the debt. Only 7 stocks are moving the market. I don't think so. Over 250 stocks by the end of this last week, up 100% year to date. 259 stocks up 100% in 2023. We have market breadth. 80% of stocks in the S&P 500 are now above their 50-day moving averages. July 14th, that is market breadth. 85% of the time, you get a 12.3% return when 80 to 85% above their 50-day moving average. Market breadth is starting to improve. Advanced decline lines, how many stocks are advancing versus declining. The strongest sector we have is consumer discretionary at all-time highs and industrials at all-time highs because we're onshoring manufacturing in the US. The housing market is bottoming. We're building new construction builds non-residential at a very fast pace, and you need industrial technology or industrial tools to build that. Industrials also have to do with the airlines, and airlines are booming right now. Consumer discretionary, same thing. People are spending, they're going to hotels, they're traveling. So this is not a guarantee. This is just a correlation. Correlation is not causation, but it's basically just more context, more layers for you to digest and make your trading decisions or make your investment decisions. The US dollar is finally starting to collapse. This is a bear flag technical signal. The dollar is giving us a very strong signal. So if that continuation happens, expect risk on. And let's not forget that stocks are still squeezing while earnings are set to bottom. The short squeeze is happening. Yeah, people are bullish, but positioning, S&P 500 net positioning has been very short, very negative. Earnings come out better than feared. As inflation has, the squeeze will continue. I expect that to happen. Valuations don't matter when everybody's underweight. Inflation is moderating. The economy is stronger than expected. Earnings could be bottoming. 41% of S&P 500 companies issuing positive EPS guidance. The highest number of S&P 500 companies issuing positive guidance since Q3 of 2021. Information technology and industrial sectors have the highest number of companies issuing positive EPS guidance. So earnings may be bottoming. Negative EPS guidance has been decreasing. And when you get the upswing of positive EPS guidance increasing, that's where you get the market looking forward to say, we've bottomed in earnings. We're going higher. Let's go. We broke the bear market trend. We're above all the moving averages. The dollar is breaking down. The Fed is at pause. Inflation's coming down faster than you expected. You got global breadth. AI is a big narrative that nobody understands. It's going to continue to create more productivity at a tenth of a cost. Here's when valuations really do matter. When investors are overweight stocks, when they're overweight tech companies and the valuations are up too much, then, that's when concerns do come into play because you're like, oh, shoot, okay, I do own it. I'm up 30%. Maybe I should shave some off. We're a little overvalued, right? That's when it comes into play. When you're underweight, when the macro is improving and when you're coming out of a bear market, and everybody knows out of a bear market comes the bull market, the secular bull market. In green, you have the dollar. In blue, we have global net liquidity. Global liquidity is bouncing because, as a rule of thumb, when global economies start to weaken, there's only one answer to that: more liquidity. And we see it in China, we see it in Japan, we see it in Brazil, we see it in India. Either the government spends or the central banks start buying up the debt to remonetize the debt to get growth going again, or else everything collapses, going to a third world country. China still printing. The US Fed balance sheet is actually making new lows. Maybe the Fed's balance sheet doesn't go up. Oh well, Japan is still stimulating and global liquidity is still picking up. Forget the Fed's balance sheet. We haven't even took into account government spending. Here's the real QE. We just got Biden administration forgiving $39 billion in student loan debt. Before that, we had Biden announce a $42 billion high-speed internet initiative, the Inflation Reduction Act, the CHIPS Act, infrastructure bill, 1.2 trillion. There's not much else to say. Liquidity is still rising. Global liquidity is picking up. Here's the G4 money growth year over year. This is M2 money supply from the US, from Europe, from Japan, and from China year over year. The gray area, that's basically negative. So we're bouncing at a negative. When you go from the very bottom to the top, you're basically getting net inflow of money supply, net inflow of liquidity that fuels markets higher. Is it going to be a bumpy road? Sure, because the recession concerns are still there. There's banking risk. Inflation isn't defeated yet. But again, central banks, when economies are weak, they continue to print, and China will keep printing because their system is weak. They have zero inflation. They will keep printing, and global liquidity will continue to pick up.